So think about this for a second. What if the money in your bank account wasn't just a number on a screen, backed by, well, a promise? What if it was backed by an actual physical bar of gold, or a piece of land, or maybe even the phone you're holding right now? It sounds pretty wild, right? Well, today we're diving into a really ambitious plan from a project called ENTIFY. They're trying to create what they call real money. Let's break down what that even means.
And this quote right here from ENTIFY's founder, it really gets to the core of the problem they think they're solving. He's basically saying that the whole financial system we use today, it has this massive flaw. It's almost like it's built on a bit of a magic trick, an illusion.
So what's the big problem? Well, according to ENTIFY, it's the very money we use every single day, what's called fiat currency. Their argument is that this money is basically created out of thin air by banks. And, because they can always just print more of it, its value is pretty much always going down. It's this slow, constant decline.
Okay, so what's their big solution? They want to go back to what the founder calls real money. And the idea behind it is actually pretty simple, but it's powerful. The concept is that every single token, every unit of currency, is directly created from and backed by a real, tangible, physical asset. Something you can touch that has actual value in the real world.
Now, to really wrap your head around this, you've got to understand their main metaphor. Just picture this. You have a lump of gold. Now, what they call tokenizing it is basically like melting that big lump down into, say, 1,000 little gold coins. You can take those coins and spend them. They're money. But, and this is the absolute key, your original lump of gold, it's gone. It's been completely transformed into that money.
And this is where it gets really interesting, because you see just how different this is from our current system. Right now, in traditional banking, a bank holds an asset, like that gold. Then it creates money based on it. But, and this is the big but, they still have the gold, so they can do it again and again. ENTIFY's system says, nope, not going to happen. Once you tokenize an asset, its value is liquidated. It's a one-time deal. You can't use it to create more money ever again.
Okay, that's the metaphor. And, with a lump of gold, it makes perfect sense. But what about other stuff? How does this whole idea actually work with other real-world assets? Things you can see and touch. Let's take a look at how they plan to apply this.
All right, the most obvious example, of course, is gold itself. So you've got this physical lump of gold. It gets verified, it gets a digital tag, and then it's locked away securely in a vault. From that gold, a fixed number of tokens are created. And that's it. That specific piece of gold is done. It can never be used to make tokens again. Its value is now out there, in circulation, as money. Now, they apply the exact same logic to something like land. If you can prove you have absolute ownership, the legal term for that is allodial title, your land gets valued. But get this, it's not valued in dollars, it's valued in milligrams of gold. Then it's tokenized. And here's the really mind-bending part. You still own your land. You can still use it, but you've just unlocked its value and turned it into spendable cash. And they take it even further. This concept can even apply to products. This is a great example. In their vision, if you were to buy their ENTIPhone, you'd get the actual phone, right? But at the exact same moment, you'd get its full value sent right back to you in their tokens. So you're immediately given capital to start spending inside their economy. And it's a pretty wild idea. So, this all sounds pretty straightforward, right? But then you run into a really, really important question. What happens when assets go up in value? Let's say you tokenize your house for a certain amount, but years later it's worth way more. How does a system that's supposed to be fixed deal with that kind of growth? Let's walk through the example they give because it really helps clear this up. Imagine you tokenized your house and got, let's say, 1 million tokens for it. You go and spend those tokens. A few years go by, the housing market goes crazy, and now you sell that same house for 2 million tokens.
Okay, so what happens? You, the seller, you get 1 million tokens. And that makes sense, right? That's your profit. It's the new value your house gained since you first tokenized it. It's your equity. But wait a second. The buyer paid the full 2 million tokens for the house. You, the seller, got your 1 million in profit. So where did the other 1 million tokens go? The original million that represented the house's first value.
Well, that original million goes into this really important mechanism they call the insurance pool. And this is not just some big pot of money. It's designed to be a clever economic engine that keeps the whole system stable by purposefully taking tokens out of general circulation.
Think of this pool as the system's economic shock absorber. So if an insured asset, like a house, gets destroyed in a fire, the pool pays to rebuild it. This makes sure the tokens that were created from it are still backed by a real thing. It also fights inflation by soaking up all that extra value from sales. And according to the source, if the pool gets too big, it can actually start funding brand new assets instead of the system creating new tokens. It's all about keeping the whole thing in balance.
And all of this, it all leads to the ultimate vision that's laid out in the source material. It's an economy built on 3 core ideas. First, it's private. Your transactions are kept anonymous inside a personal trust. Second, it's stable. The value is tied to real physical things, not a currency that can be inflated away. And finally, it's sovereign, because you get to keep full ownership of your assets even after you've unlocked their value.
So the big question is, can separating an asset from its value like this truly create a more stable, a more fair economy? Is this the future, or just a fascinating experiment? It's a question that really makes you think about what money even is in the first place.